Hello, and a very happy 2019 to everyone. Welcome to the 2019 Small Farms Winter Webinar Series hosted by the University of Illinois Extension's Local Food Systems and Small Farms team. We are back for yet another round of weekly webinars focused on content with the small farm in mind. My name is Zach Grant, and I am a University of Illinois Extension Local Food Systems and Small Farm educator housed up here in Cook County. You will continue to hear from me via email and moderating many of these webinars. We really appreciate you joining us again this year, and we're going to do our best to begin and end within the space of your lunch hour each week. This is a tight time frame for our educators, so please understand why we're going to limit your questions to the text box at the left, and we'll try to get to those at the end of the presentation, or possibly if the momentum of the webinar takes us there. This presentation is actively being recorded, and I will email a link to the archived presentation as soon as possible after this concludes. There will be a short link for a very brief online evaluation of this presentation, and we really appreciate your feedback to continue to improve this series. With that, our first speaker coming to you live from Kaskaskia Community College is Pam Shellhorn. Pam is a community and economic development educator at the University of Illinois Extension in Bond, Clinton, Jefferson, Marion, and Washington counties. Her responsibilities include assessing, developing, and teaching community and economic development programs while working closely with stakeholders, community leaders, economic development professionals, and the general public. Her programs enable Illinois communities, nonprofits, small businesses, and local governments to build economic opportunities, enhance quality of life, and increase their funding revenues. Pam holds a master's degree in poli-sci from the University of Illinois at Springfield and a bachelor's degree in finance from Northern Illinois University. She's originally from Rockford. However, she has held positions in Chicago, Sterling, LaSalle, and Springfield, Illinois in a variety of contexts ranging from commercial lending and administration in several Midwestern regional banks, contractual community development work, to public speaking and education around entrepreneurship. We're looking forward to learning from her diverse background and applications on why small farms should be paying closer attention to their financial statements. So with that, you can take it away, Pam.
Thank you. What I'm going to be talking about today, well, and first, before I even get started, I do want to thank Kaskaskia College for hosting me today, giving me the opportunity to use this great room, and also bring all of their agricultural students in to watch the presentation. The reason I'm giving this is that my focus right now is not in agriculture. My focus right now is on community and economic development. However, back in the early 80s, I finished college, got my degree in finance, and went to work for Continental Bank in Chicago. I then married someone and moved to rural Amboy, Illinois, and went to work for Central National Bank in Sterling in 1986. Because of my background in finance and also the fact I was a credit analyst, I was quickly moved into a position as an agricultural lender during the crisis of 1986 to 1990. It was a very traumatic time. As I've watched profits fall for both commercial and small farmers, I decided that I wanted to be able to take the experience that I had in the late 80s and hopefully help some of you as profits continue to fall, if that's what's going to happen. I am not taking a negative attitude today. What I want to do is I look at this as, how do I want to put it? My stepfather always said, hope for the best, plan for the worst. So today we're going to look at some ways that both large farmers that are suffering under the retaliatory tariffs, looking at soybean prices being at, really have taken a hit, as most of you know, and just trying to give you some insights as to how you can work with your lender. So as I present this today, I am going to present everything from a lender perspective. I am the lender, and I'm just going to give you some advice on how to look at your financial statements, how to better prepare before you talk to your lender, and how to negotiate over time, hopefully saving you a lot of the heartache that some of the farmers went through back in the late 80s. And just before I start, I'm going to tell you that there is one huge advantage right now, huge advantage to the farmers, and that is the level of interest rates. Your interest rates are nowhere near as high as those experienced in the early and mid 80s. Back then, having a 16, 17, or 18% interest rate on an agricultural loan was considered the norm. Right now, I'm not sure where they're at. They're probably ranging somewhere between about 6 for their best borrowers, anywhere up to maybe 8. Okay? So just envision if you had the same debt load at 18% versus 8%. That's huge. So that's a bit of good information, and I want to, like I said, I want to keep this as positive as I can. Okay, so the first thing we're going to take a look at, and hopefully everyone can see the balance sheet, is we're going to take a look at a balance sheet. I am not here today to teach you how to prepare a balance sheet, okay? I understand that most of the ag students in the room just got out of their accounting class, and I am thrilled to death you're learning accounting. But I do know that back in the 80s and even today, farmers usually hand over all of their receipts at the end of the year. They get their financial statements put together, their income tax statements put together, and they hand them to their banker, and then pretty much that's it. So I'm just going to give you some very basic ratios real quickly. But as we talk about it, like I said, I'm going to try to give you that lender perspective. First, the balance sheet. You're going to notice that I do have a red pointer I've figured out how to use, which makes this presentation much easier than when I gave it last year. We want to look at, when you're looking at a balance sheet, there's basically 3 things. You've got assets, you've got liabilities, and then you've got equity or net worth. One of the things that trips people up the most with financial statements is there's always another way to say it. We have financial statements, we have income statements, we have profits and losses, we have balance sheets. So I don't want to get you confused at that. I just want you to zoom in on just a few things, a few ratios. Okay, so the total current assets you can see here, those are current assets. Those are assets that you have that can be liquidated within 1 year and used to pay your liabilities, household, and other expenses. But all of them are can be liquidated within a year. Then you have your total fixed assets, which are things like machinery, equipment, land. And then you have your total farm assets. And in this case, you can see that's $680,565. These are no one's in particular financial statements. These are just ones that I created for demonstration only. On the right-hand side of the balance sheet, you're going to see farm liabilities. You're going to see the first one is the current liabilities or short-term liabilities. They're all liabilities that are required to be paid within 1 year. In this case, this particular farm operation has $259,930 in current liabilities. Then you go down, you see the other liabilities, which generally include longer-term loans, or the portion that's going to be paid after 1 year. Machinery loans, land loans, equipment loans. Then the easiest thing to learn is that you take your assets, you subtract your liabilities, and what you come up with in the end is your net worth. It's also called equity, but it's really the portion that the farmer owns is that equity. That's what you own. Those are the assets that are yours. So assets minus liabilities equal net worth. Okay. The first ratio I want to talk about is the current ratio, and the second one will be working capital. What bankers are, I'm not going to use the word banker because I understand farm credit people or lenders do not like to be called bankers. They prefer to be called lenders. So I'm going to try to use the word lender, but I was a banker for 25 years, so I might accidentally pop back to that old terminology. So what is liquidity? Liquidity is the ability of your farm business to meet financial obligations as they come due, to generate enough cash to pay your family living expenses and taxes and make debt payments on time. If I'm the lender and I'm looking at this is one of the most important ratios is your current ratio, because basically what it's telling me is, are you going to be able to pay everything that you owe in the next year? Are you going to be able to pay that on time? And right now, this is where lenders are saying they're becoming very nervous. I think a lot of farmers are also becoming nervous because of their inability to sell their soybean crop or their inability to sell it at a price that's going to give them a profit. Some of it may be stored. They don't know how long it's going to be stored for. This can make everyone nervous, and I think this is one of the main reasons I'm giving this presentation, is because panic is what created a lot of the ag crisis in the late 80s. People panicked. They started selling land. They started selling equipment. The lenders and the bankers became concerned, and so they started to force farmers out of their operations. And as everyone came into the market with this land and everyone came into the market with this used equipment, it created a flood of equipment and land. Land prices dropped by 50%. Now, I know this is a lot less than what you would expect today, but back in 1987, you could buy an acre of land around Sterling, Illinois for $3,000. Excuse me, 1985. By 1987, you could buy it for $2,000 to $2,500 an acre. So you could imagine what that does to a balance sheet, to those fixed assets. You can imagine what that does to a farm operation, or where are you going to go? You can imagine what it did to the lenders and what kind of a panic it created. And it really was devastating. In fact, the year I became an agricultural lender is when John Cougar Mellencamp wrote Blood on the Plow. And it was a song about bankers putting farmers out of business. It was a very tough position for me to be in. I was only 28 years old. And it was very difficult to work with farmers. Because of my finance background, they decided I would be one of their number one, and I did become one of their number one liquidators, meaning I helped probably more farmers in the Sterling, Illinois area go out of business in the late 80s than anyone else. And it was not an easy job. But I do feel that because of my finance background, and because I could understand where a farmer was coming from, that I was able to help negotiate deals that got farmers out in a lot better shape than what they would have with someone else that didn't have that financial background. And that's why I think that if I recommended anything for a farmer, it's learn how to read your financial statements. Don't just depend on your accountant and your lender to do it for you. If you don't know how, there's great classes. University of Illinois Extension has a class on FarmDoc. I think that's what it's called, right, Lori? She's shaking her head, yes. We have the instructor here from Kaskaskia College. I'm sure your community colleges all have accounting courses. The first thing I'm going to recommend is if you don't know how to read the financial statements, if this is confusing, you need to learn how. You need to be able to understand your financials because it's going to help you ultimately control your destiny as a farmer. You know, whether you're starting out, whether you're in the situation now. So liquidity, it's how much money do I have to pay my bills. The current ratio, and we're just going to pop to the next one, and I'm going to show you how you calculate a current ratio. These 3 or 4 or 5 ratios I'm going to show you, it's easy. This is not tough math. The current ratio is nothing but your total current assets, remember I said those that could be liquidated in 1 year, divided by your total current liabilities. So that's the total amount of debt that you need to pay in the next year. Can everyone see this? Okay. If anyone has any problems, please let me know. That includes you, Zach.
No, we can see it.
Great. Okay. So in this particular instance, the current assets divided by current liabilities is 1.44. 1.1 to 1.7 is good. Now, to be honest with you, I never saw 1.44 when I was in ag lending in the late 80s because most of those were actually less than 1. In fact, I had an intern for a while that came in and was concerned because all the financial statements he was looking at even had negative net worth. And he had gone through an accounting class and had no clue what negative net worth was. And I said, well, welcome to ag lending in the late 80s. That's what it was like. There were a lot of people underwater. So basically, you're talking about a 0.8 current ratio means you've got 100,000 in current liabilities, and you only have 80,000 in current assets. So you don't have enough money to pay your loans back. Okay, so now I'm going to give you, as we move through this is the one thing I want everyone on this call, everyone in this room to remember. Don't break down your relationship with your lender. Keep in touch with your lender. If you feel you are ready or are experiencing any problems, make sure you keep that relationship going. Now, I will let you know that if the regulators come in and decide that they're going to classify that, what they call classify a credit, meaning that they're going to say that they're afraid that this credit is, or this farm operation is not going to be able to pay back everything, they may change lenders on you. I also know that your FSA lenders who have been out furloughed are being asked to come back, but they're going to be working without pay. So here's some lenders who are going to be under additional stress, who are going to be looking at your farm financials. And that's why you need to take responsibility for understanding what they say and take responsibility for keeping in touch with your lender. What you want to do is you want to keep talking with him or her. You want to put yourself in a position where you can negotiate. And this doesn't have to happen in a crisis. All too often, this happens with young farmers coming into the business. They don't know. They're focused on their farm operations, but they're not paying attention to their financial statements. They're not building this relationship with a lender. This is critical, especially when you find yourself in a little bit of trouble. Okay. The other ratio that we're talking about here is working capital. That's the difference between your current assets minus your current liabilities. In this case, about $115,469. That's how much money you have extra. You have that much money extra. It's sort of like a savings account. That's the way you can look at it. You have that many more assets than liabilities. So let's say, for instance, maybe this year, when you do your projections, financial projections, you see that you're not going to make any money off your farm operation because you're not sure, or you're putting everything in the way it was in 2018 with the current tariffs, with the current prices, and you're seeing that there's not enough money to pay. This is the money that the lender is going to look at and say, oh, but she's got $115,000, and that's going to carry her maybe for 1 year, for 2 years. That just means that you're stronger. You've got a stronger financial statement. You're stronger. You've got more money. I think one of the biggest issues I saw back in the late 80s was people didn't realize they had an issue soon enough. They were, how do I want to put this? The lenders and the farmers each year were, it's going to get better, it's going to get better. Lost $30,000 this year, couldn't pay back $30,000 on my operating line. The next year, oh, it's going to get better. Have another $40,000 in operating I couldn't pay back. Now I have a total of $70,000, which, by the way, lenders call that evergreen loans. Okay, it really should have been termed out. I mean, literally, I had clients or customers of the bank that came to me, and they had 4 or 5 years in 1986, 7, and 8, 4 or 5 years of past due operating debt that they hadn't paid on, that hadn't been restructured. They hadn't even paid the interest. So this became a real problem because all of a sudden you've got all this extra operating line, and that's when we saw those current ratios that were below 1 to 1, because over in the short term you're collecting this all in short term. Like, okay, now I've got $100,000 in operating to pay off, but then at the end of the year I'm carrying over 30. Then the next year I've got 130, but then I carry over 40. So that's when bankers start really getting nervous, and what you really need to do is look at how you can work with your lender to negotiate that past due operating debt, restructure it into something on a longer term, maybe 5 years if they'll let you. Do it as quickly as possible. The other thing I'm going to warn you right now with this current ratio is if you have not set up your operating line for next year with your lender, whether it's FSA, whether it's a traditional bank lender, whether it's farm credit, you should not be prepaying for expenses for next year. If you are, make sure you're prepaying them in cash. Do not use your old operating line. Not only do the lenders get nervous, but the regulators that are going to look at these financial statements are going to be very upset with that. Now, prepaying is not unusual. In fact, you may even teach that in some of your ag classes, is that a lot of times your accountant will even say, oh, go ahead, prepay those expenses because it'll reduce your income and you won't be paying as many taxes. But when a lender looks at that or a regulator looks at that, they're going to say, no, you want to keep all of your 2018 expenses in your 2018 operating line, and you want to spend when you get your 2019. Now, if you're a seller and you got the cash to do it, go ahead. It will save you some money on your taxes. But if you're relying on a lender to give you an operating line, and that lender hasn't even looked at your 2018 financial statements, that lender hasn't even had you in his or her office yet, you do not want to be buying 2019 supplies on your 2018 operating. You don't want to do that. You want to make sure you pay all the interest, you pay all that operating debt, and then you start new. Now, I would recommend you talk to your lender. Again, that's part of the relationship, but with the FSA lenders on furlough right now, I don't know if they're back yet. Have you heard? Okay. They may say, okay, you may be in good enough shape that they say, okay, go ahead, you could go out, but I'm not going to guarantee that. I'm not even going to recommend it. I'm saying try to, right now especially, as the lenders get more nervous, that's what also makes it, is that even though maybe you're an average credit, you know, or you've done a pretty good job of what you're doing, as they become more nervous, it's going to spill out over onto everybody. You know, the regulators get nervous, and that's what I said. It's really the panic that created a lot of what happened in the late 80s. Next, the debt to asset ratio, this is critical. It's looking at how much of the farm operation you own. How much is the bank financing? Now, to calculate it, it's pretty easy. Let's move my red pointer here. You can also see with the yellow arrows. Total farm assets, or excuse me, total farm liabilities over here on the right side, 394,656, divided by total farm assets gives you your debt to asset ratio, which you can see up here is 0.44 or 44%. Okay, that means the bank or the lender owns 44% of the farm operation, and you, the farmer, owns 56% at market value of those assets. This is fantastic. Most people do not own that much of their own land until they're, well, probably pretty close to retirement. I think most everyone, you know, is going to own maybe 60 or 70%, which means that, the bank is going to finance 60 or 70%, and you're going to own 30 or 40% of that land. Now, this was a huge problem in the late 80s. Envision for a minute, your land is worth $5,000 an acre in 1985. By the beginning of 1987, your land's worth $2,000 to $2,500 an acre. What happens to this debt to asset ratio? It switches. You used to own 50% of your land, now you don't own any of it. The bank is financing 100% because you were financing 50% to begin with. You can imagine the devastation, and unfortunately, a lot of the farms I dealt with were what they called centennial farms. They'd been in families for over 100 years. I've also done a lot of workouts in commercial loans as well. In fact, I've worked out loans as large as $4 million. That means I'm working with the businesses to try to get that money back. It's not the same as dealing with farmers. Never has been. Farmers are a part of their land, and the land is part of a farmer. It's not the same way with a commercial business. The business is important, but it isn't where you live at. It isn't where your family lives at. It isn't part of a farm that may have been passed down generation to generation. This creates a lot of emotions. It creates an enormous amount of stress. And there are a lot of people out there right now looking at ways to help farmers with stress. And if you do feel like you're under stress or you're feeling very depressed about all this, I really recommend that you seek some help. That was another thing that did not happen in the late 80s. But I am recommending that. So like I said, as your things are revalued, if you've got a lot of used equipment going out on the market, and I just talked to a lender, an ag lender in Mount Vernon, really sharp guy, and we were talking about this because what he's afraid of is if the banks or the lenders start to panic, that what you're going to do is go out and try to sell these assets to pay down your debt. And we're going to have all this used equipment flooding the market. We're also going to have equipment dealers, as this moves through the system, that aren't able to sell their new equipment as well. And of course, that's one of the first things you do when you think you might be having problems, is you want to make sure that you're keeping and holding back as much cash and liquid assets as you can to keep you through these hard times. But then that means that you're going to have to avoid some purchases. The profit margin, I'm going to take a look at this financial statement, and the reason I am is this is really this was put together by the Illinois Farm Bureau. It was actually in 2000, and what it shows is the top 20 farm operations, averages, the 20 to 40, middle, lower 60 to 80, bottom 20%. And if you went through the calculations for your for the profit margin, which is basically net farm income divided by total farm income. So for the top 20%, that's the 149,476 divided by 705,446 to equal 21%. Doing the same calculation on the low, you're going to see that it's 13%. I'm venturing to guess if I could get numbers for 2018, this spreadsheet would look a lot different. According to information I received from Ag Economic Insights, state-level net farm income, comparing the average from 2011 to 2013 when soybean prices were at $16 a bushel, comparing that to the average net farm income average of 2016 to 2017, net farm income has dropped in Illinois by 65%. And across, I have this map. I do not have it in the presentation. I'm sorry. I just found it late yesterday afternoon. But states like Minnesota, it's dropped as far as 70%, and some places more. Now that's huge. That means you were living with a lot of positive profit, high profit margins and positive cash flows back in 2011 to 2013. Now today, 2016 to 2018, they've dropped by 65%. So I have a feeling that bottom 20% is going to change. In fact, I wouldn't doubt that some of that profit margin is going to actually be negative because your outputs continue to rise. Your inputs continue to rise, and your prices for the grain are going down for a variety of different reasons. So you're going to continue to feel that pressure. And again, that is the reason why, if you're the type of farmer that has had an operation and you have never looked at one of your financial statements, that you're not even looking at your income tax, you're not comparing this every year to see where you are, you need to switch that. You need to understand those financial statements. You need to know where you are, and especially if you're going to have to negotiate with a lender. The income statement comparison, what I do with this is I was also a credit analyst before I became an ag lender, and what I look at are trends, and so do the ag lenders of today. They're going to look at where you were in 2016, 17, and 18. They're probably not going to go back 5 years, especially because of the changes. But what they're going to want to see is they're going to want to see, are your operating expenses increasing? Now, in this case, they're not, which means that I'm not sure where I got this income statement from, but it's probably not very real as of today. But they're going to take a look at trends. And what I mean by a trend is, let's take a look at corn sales on that very top line. In 2016, the farmer sold 72,483. In 2017, sold 79,345. 2018, 87,536. What that tells me, or it would tell your lender, is that this particular operation has done pretty well with corn. You know, either they're using some things to where they're able to produce more and sell more. We know that the crop prices haven't been that different year over year from 2016, 17, and 18. So that would be a positive trend. When we look at soybeans, and I did this just for an example, the soybeans in 2016, 66,542. In 2017, 60,482, and then this year, 40,952. Well, most of that is because of the price of the soybeans and what you're able to sell them for, and the retaliatory tariffs. You did have, I believe it was called the Market Equalizer Program that the USDA is putting on. I may not be saying that correctly, which is going to give you a total of about $1.80 a bushel for soybeans. That is going to take some of it away, not all of it away, but it will take some of it. But according to the USDA and the administration, they do not plan on giving those again this year. So if soybean prices stay at the same amount, this could be a problem at the end of the year. In fact, right now, there might be lenders out there that would disagree with me. Please feel free to put something in the chat box. But right now, until something significantly happens, I really encourage anyone putting together financial statements, projections for 2019, use what you've got today for prices. I would not expect it. At least don't bank on it, so to speak. You know, use what you've got for prices today. Use what you've got for inputs today, and project out to the end of the year for that. You may, in essence, be projecting a loss, but that's when the lender is going to go back and look at your current assets, your fixed assets, because, of course, with whatever loan accommodations they have for you, they have already taken most of the collateral that you have, or they have collateral to cover that. They may be coming to look for more if you're a lot underwater, but at this point. As you can see down here on the accrual net farm income, which is what we were talking about, had decreased by 60 or 65% in Illinois over the last few years. The net farm income was positive in 2016, positive in 2017. Now there's a loss, 23,511. And unfortunately, this is when you will recognize a difference in your lender's attitude when you go to visit him or her. That loss is going to be bothersome for them because, one, they're going to have to make sure that everything has got enough collateral out there for it, that you've got the ability to repay that. And another thing is that this is probably going to mean that you're not going to pay all your operating line back. So what are they going to do with that? Remember, that was a liability due within a year. Well, you're not going to be able to pay it within the year. So now something else is going to have to be done. And again, can't stress enough, keep in touch with your lender. They call you, get back to them. The worst thing you could do is break down that communication, and guaranteed, if you have any signs of problems on your financial statement, you will not be able to move that credit line unless you can find another lender, maybe like one of the other, not lendings, but one of the other governmental, government supported, or maybe through Farm Credit. But just a note, I went back through the history in the late 80s, and Farm Credit almost went out of existence in the late 80s. In fact, it took them over 20 years to pay back the money they owed. They were a farm-operated Farm Credit, which they still are, and they're very proud of it, and that's great. But I couldn't remember why I never worried about competition from Farm Credit, and when I went back to look at it, they had waited too long. Seriously, farmers were not even doing financial statements. I can remember farmers bringing in notes on a napkin to show me how many assets they had and what they owned for collateral. So you've come a long way, but it's still a lot of times I don't think you're giving enough value to those farm financial statements that you get. Okay, here's net cash income and net farm income. As you can see, what's happened since 2000, that all peaked right about 2013, 2014, and now it's coming down, and then what they were forecasting for 2018, even slightly lower. These are not great trends, and I am hoping against hope that something changes in the near future. But again, like I said, I would say that you really want to keep your projections. You want to look at what you're going to be doing for the next couple years based off of this. Now, that doesn't mean you don't go out and try to decrease some of your expenses. But my colleague, Dr. Lori George, who's over here helping me, she keeps me informed on a lot of things that are going on, and I don't think I see a lot of changes, not in the next 6 months to a year. Okay. Now your debt coverage, repayment capacity, huge for your lender. Sometimes they're going to go here first. All right, we're going to look at these. You looked at that bottom, the accrual net farm income. And for all of you accounting students that are in this audience, you're probably going to, you know this right off the top of your head. But for those of you that don't, that accrual net farmed income, when they say accrual, and I don't want to go into too much detail, but if you pay, how do I want to put this? You know, I just think that that's going to be too technical at this point. Let's leave accrual net farm income is what your financial statements say after all your expenses come out, including depreciation. Okay, so that's why on the next line here, you're going to see that we add depreciation back in. The reason is depreciation is not really a cash expense. And what that lender and what you're trying to get down to here in adjusted cash income is how much cash are you going to have at the end of the year to pay your debt for next year, whether it's your operating line or the short-term, you know, the current portion of your long-term debt. So here we're going to add depreciation back in, add off-farm income back in, which, by the way, a lot of you, I'm sure, are just still doing off-farm income. I mean, that's maybe how you're supporting your families while you're doing your farming. And then minus your family living expenses. And you even notice that this family is trying to keep their living expenses as low as possible. But what you'll see is that negative $23,511, once all that is added or subtracted out, becomes an adjusted cash income of $18,489, negative $18,489. Down here, looking at the balance sheet, due in 12 months fixed, this is probably the short-term portion, or the current portion, what's due in the next year on your long-term debt, your machinery debt, your land debt. $15,487. As you can see, it's lower. I mean, it cannot be paid. Not only can it not be paid, you're still going to be $3,000 short after that. You've got a negative $18,000, you owe $15,000. Excuse me, I said that incorrectly. You are way off. You were able to pay 3.53 times in 2016. You were able to cover your debt 2.43 times with the $37,580 in 2017. And in 2018, you're not going to be able to cover it at all. Now think about for a minute what that means. If you're in the hole $18,000, so let's look at it just from one cash account, your checking account. And don't think that farmers can't get overdrawn $18,489. Actually, what that probably means is you've written checks out. It's gone on your balance sheet. You haven't sent your checks out. And I remember that was a game that a lot of the farmers played in the late 80s, is get the checks out and then wait. It can be a real struggle. I can't even start to tell you what a traumatic event it was. Okay? But this individual is not going to be able to pay their long-term, the current portion of their long-term debt. They're probably not going to be able to pay a part of their operating line. This, even though they've done really, really well, even though they still have money perhaps in the bank, this is where a lender is going to pull this out, and they're going to want to take a look at it, and they're going to want to talk to you about it. They're going to want to know what your plan is for this year. And I know one of the most frustrating things, and I have tried, is what are you going to plant? How do you project when you don't know what you're going to plant? If you're cash renting, one of the things that I think they should have done earlier in the late 80s is talk to your landlord. If your landlord is in a position to negotiate with you, try it. Especially if you're struggling. Especially if you know that you're projecting a loss at the end of the year. Is there any way they would negotiate that cash rent down? Now, the thing is that I talked to a farmer actually not a farmer, he was a commercial ag educator with the University of Illinois, and he said, well, he says, I think what they're going to say to you, Pam, is they're going to say that if I say that, either you negotiate this down or I'm just not going to take the land, somebody else is just going to grab it up. Well, in lending, one of the things I learned is that just because somebody else will do it doesn't mean you should do it. Just because somebody else is coming out there thinking that they can do it, it isn't necessarily they're going to make one dime more than you are, and that they may be hurting as well. So you've got to make decisions for your own farm, your own family, and your own future. And the only way you can make those decisions is by understanding, looking at these financials, looking at what your trends have been over the last 3 years, and then projecting out. And unfortunately, I do not have any other crops to recommend at this particular time. I know some people are taking, there's a lot of workshops right out there right now on hemp. If that's something that you are interested in changing it, but keep in mind is that if everyone does the same thing at the same time, right? I have a gentleman in the audience who's grinning, and I think he knows what I'm about to say, is that when all of the farmers do exactly the same thing, when they float, it's like watching a swarm of those birds, is it swallows or sparrows, that they all form together and they move together. If they move together, then what happens? If everybody goes into hemp, what's going to happen to the price of hemp? If everybody goes out of soybeans into corn, what's going to happen to the price of corn? Because what's going to happen is you're going to end up perhaps glutting that market, and those prices are going to go down. So is it tough? Yes. If you have an accountant that you trust that can help you with these financials, but definitely work with your lender. You're going to have a tough time this year. I'm not going to deny it, planning what you're going to do for 2019. But finding ways to reduce expenses, maybe talking to the commercial ag educators or the small farm local foods educators to talk about ways to reduce expenses on your farm. Maybe I also went to another ag economic. I was preparing for all of you because it's been a while since I've been in ag, and they were talking about ways that there's a way, the cheapest way to till, 1 time, 2 times, no till. Well, this is the time when you want to look at every single line item on your income statement and say, do I really need this? Can I make it? Can I do it a different way? Can I make more profit next year? Because basically looking at that, you're just making pocket. Now, this is another thing that is really worrying lenders. They're getting very, very nervous. Oops, sorry, I'm pointing at the screen. I apologize to everyone on the webinar. But as you notice, this is farm debt. As that farm debt rises, that's going to become more of a problem for the lenders, especially if it's not getting paid back. And a lot of that has built because, honestly, farmers have been struggling with net profit for the last 3 to 4 years. What did I say? 2013 was the last time it was that high, and then it started to come down. And that's what you're seeing. We're going to come right up here around 2006, 2007. That farm debt just keeps going up and up and up. Okay, I'm just about ready to end this presentation, but I want to let you know that I found these are really great spreadsheets. This first one is a way for your farm finance scorecard, and I'm going to show you the next sheet first. This is a sheet, and if you want them, I will be sending out the PowerPoint, or I should say Zach will be. We'll be sending out the PowerPoint, so you'll be able to find these. This first page shows you how to calculate it, how to calculate those ratios. This sheet, once you've calculated it, you can go out and look at the right side of this, and you can see anything less than 1.1, that's going to be in the red zone. You can kind of say that's when the lender is going to start getting real concerned. Anything between the 1.1 to 1.7, that's pretty good. Average over here in the green area over 1.7, that is very strong. But you're going to find very few farm operations right now after the last couple of years that have these kinds of ratios over in this green area. So what you're struggling for here is in this yellow line. So before I conclude, I just want to go back to, and there is my email address for any questions you may have, but you're more than welcome to ask them after we're finished. What I'm trying to impress on everyone today is, one, stay in touch with your lender. If they change lenders on you, is that a bad sign? Probably is, but don't let that deter you, okay? Think about what is most important to you. If it's the farm that you want to stay on, well, then you need to work with that lender. Even if it's not, getting out sooner rather than later can save a lot of assets. And I'll give you a quick story. I had a gentleman who came in. He had inherited a farm back in the late 80s. And once I talked to him, I found out that he had always wanted to go get his master's degree and become a school superintendent or school principal. He was probably only in his mid-30s. He had had operating losses for the 4 years, because like I said, they weren't catching these. This is like the first time we realized there's a problem. You got 4 years of operating losses. I don't think your lenders are doing that today. That's what created a lot of the panic. But he told me that's what he wanted to be, and I said, you know what? If we liquidate this, we work together to liquidate this. You know, no fights. Let's just get together, sit down, see how we can liquidate it, do an auction, whatever. I thought he could hold back $30,000 to $40,000 in equity, in cash equity, once everything was sold. Well, he actually was able to hold back about $50,000. He was able to go back to school, and I'm happy to say he became a superintendent of schools in the Sterling area. So to me, that was a win. Yes, did he have to lose a family farm? Yes, he did. But because he acted, because he worked with the lender, he was able to get out of it and keep something back for himself. He didn't have a family at the time. He was single. Bankruptcy. I am not a lawyer. I'm not going to give you any advice on bankruptcy, but I will say that if you feel bankruptcy is what you need to do, talk to a lawyer first. The big mistake that farmers made in the late 80s is they thought they'd go bankrupt, and then they'd force the banks to give them operating money, and they would move on, and the courts would hold the lenders off. Problem is, a good lender's already got most of your, if not all of your collateral. So the farmer would file bankruptcy. He'd go into court and say, well, I need operating money for 2019. And the lender who had all the collateral would say no. And if he didn't have cash for that operating, or have somewhere else he could borrow it from, if you can't have operating, how do you continue your farm anyway? So the bankruptcy did not help. That's the point. Filing bankruptcy did not help them. Another thing you have to be careful of is when, say, you've got a lot of interest and a lot of past due operating debt. If they forgive any of that, you have to pay taxes on it the next year. Now, I'll tell you the example. We had a dairy farmer who actually pulled his truck up to the front of the bank lobby right next to my office and started unloading his cattle. He was going to bring them into the bank and leave them for us so that we had our collateral. He was pretty angry. He was really stressed out. And I don't blame him. It was a hard time. Okay, so we talked him into loading his cattle back up and taking his dairy. And you might have even seen the pictures when they were dumping loads of milk into the street. But we negotiated with him, and one of the things that his attorney wanted, he hadn't filed bankruptcy yet, but he brought in a lawyer to help him, was to forgive $135,000 in past due interest. Well, you don't know the inner workings of the bank, but by this time the regulators have already made the bank write off all that interest, like they are never going to collect it because the loan is having problems. So we wrote off the $135,000. We were able to collect all the principal. He sold his dairy cattle at auction, which of course you can imagine how much lower the prices were on that. So we had the $135,000 forgiven. He thought he did pretty well till the next year. He filed his tax returns, and you have to pay taxes on debt forgiven. So he ended up with like a $35,000 tax liability the next year. Well, seeing as how he had sold everything he had, that was really tough. And I think there is a way. I was not the lender on that case. It was just my office was right next to the lobby. I think there could have been a way that they could have avoided that with a different way of liquidating it or a different way of paying it down. But debt forgiven, you're going to be taxed on it by the IRS. Doesn't sound fair. Actually, back in 2007, some of you might remember when everyone was defaulting on their mortgage loans, that Obama actually waived that at the IRS for people defaulting on mortgage loans. But I've never seen where they waived that for the farmers that are trying to sell off land or assets. Now, again, I'm not trying to say that this is what's going to happen. I'm just saying the more you are educated on these financial statements, the more you stay in touch with your lender, understand what he or she wants. And, you know, getting angry, you're going to get angry. I mean, who isn't going to get angry? It's part of loss. But working with and negotiating with them can really make a huge difference. And I'm going to wrap that up and see if we have any questions.
So we do have one online question that was typed into the chat box, and
Okay.
the question is related to...
Go ahead and tell me the question, and then I'm going to repeat it to my audience because they can't hear you, Zach.
Okay. So it's what's the difference between net cash income and net farm income? And that may have been when discussing the debt coverage ratio. I'm not sure, but what can you clarify that?
Yeah, I don't know. I know that when I was talking, I wasn't moving this as well. Okay, is this our net farm income? Okay, accrual net farm income versus adjusted cash income. I've got the slide up. I'm hoping that's what they're talking about. Accrual net farm income that's the income on the income statement, bottom of the income statement, which we can see it right here too. Right here, accrual net farm income. That is all your income, all your livestock sales, less all of your expenses. But these expenses and income are done on an accrual basis. And that might be the issue with, because it's a little bit more complex. And like I said, I'm not trying to teach accounting today. But the accrual net farm income is after everything at the top. But that accrual net farm income includes the deduction for depreciation. Depreciation is not a cash expense. So you have to add that back in order to get to adjusted cash income. So you add in depreciation, you add in your off-farm income, which is cash that is, obviously coming from outside sources, and then you subtract out your family living expenses, and that's what brings you to the bottom, adjusted cash income. That's what they're going to look at, is how much income, cash income do you have at the end of the year to actually take care of your debt for the next 12 months. In the first column, they would have had $54,000. In 2017, they had $37,500. So compared to the short-term portion of the long-term debt, that $15,000, they had plenty. But now in 2018, that is negative. So that means that they have not made enough to cover all of their cash expenses and do not have enough to pay the current portion of their long-term debt.
Okay, I think they answered their question. She's asking if you can show the next slide again, I
Yep.
believe.
This one, this one.
I'm not sure. Um, so here's another question that popped up. If a taxpayer is insolvent, that waived debt can possibly be excluded from taxable income if it is a Schedule F farm. The
That must be
rule
coming from an accountant. Okay.
the rules change somewhat for partnerships and corps, but can possibly still be excluded.
Okay. What they're saying is check with your accountant on having to pay taxes on anything that's forgiven. Is that what they're saying, Lori, or do you want to say it? Okay, great.
Yeah, we couldn't hear that online, so if you want to repeat that.
Okay.
Yes, we're just reviewing the question.
Okay. Yeah. And now we know, actually, like I said, this is my first time to try to do the webinar at the same time as the class, and we've realized that you can't hear what's going on the webinar. But what it is that if you are in a situation where you're working on, and it could potentially be debt forgiveness, talk to your tax accountant first. In fact, they may even be able to show you a better way to do it, but there must be a tax accountant that's watching the webinar who has been nice enough to come in and give us a his or her advice on that. And I really appreciate that to whoever's out there.
We're getting to the chart that Karen wants.
This one? Say yes or no. That one.
Yeah, it might be that one. If not, we will. She said no. Next slide. But again, we'll have copies of this available.
Okay. And for anyone, so if what I'm going to recommend at this point so that we can let our group out is that I'm not sure which side they want, but what they can do is email me and I will verify it for them. So let me get to my email address, and what I can do is answer that question personally. Again, anyone, even the students that are here, if you have any questions about this, let me know. It is very difficult teaching financial statements on a PowerPoint because, of all the numbers, and it can be very confusing as you're trying to do the math and understand what's being said. Again, like I said, just keep in touch with your lender, tax accountant, talk to your tax accountant before you make decisions. I think that was the toughest thing, is people trying to just no head in the sand. Gotta get the head out of the sand. You've got to face it. You've got to move forward, and everybody's going to be a lot better off if you do it that way. Thank you very much.
Well, thank you so much, Pam, for the fabulous presentation and sharing your experience. And thanks, everyone, for joining the webinar. Look out for a link for the archived webinar on our YouTube channel and a short evaluation for the webinar you just watched. And we really appreciate your feedback. So thanks, everyone, for joining us today, and a productive start to the 2019 season.
Great. Thank you so much.